Hi, and welcome. In this session, we'll break down one of the most crucial metrics in financial analysis, earnings per share, or call it for short, EPS. Whether you're preparing for exams, professional qualifications, or you are a seasoned financial or finance professional looking to sharpen your skills, understanding EPS is vital for assessing the company's profitability and making informed investment decisions. Let's dive into the formula, its implications, and how EPS can directly impact the stock market and investor confidence. Stay tuned for a real world example. Let's dive in as I share my screen and I go many me as I humorously say usually. Let's look deeply into this fantastic ratio or metric. Okay, I've got mini now, like I said. All right, one of the main investment ratios is earnings per share. It measures the amount of profit earned during an accounting period for each ordinary share issue during the period. So we're looking at every ordinary share owned by shareholders, the owners of the company, and how much from profit they are able to glean dividend or take dividend in an accounting period. The formula is clear. The profit after tax after deducting all expenses, organic and inorganic, and special interest or fixed interest dividend have been paid to preferred shareholders. We divide it by the number of ordinary shares in issue, and the earnings per share is provided to ordinary shareholders. It's a key financial metric that indicates the portion of the company's profit allocated to each outstanding share or common stock. So every shareholder that has invested in the company in the form of shares is entitled to dividend, and this dividend is procured or gotten from profit declared or generated after tax in the company in that particular financial year. The earnings per share is a vital indicator of the company's profitability and is widely used by investors to gauge the company's financial performance. So every financial year, the gauge for performance of the company and its management is how much it's able to declare dividend and how much in naira or in kobo the dividends are appreciating in value for ordinary shareholders. This is very important. Earnings per share provides insight into a company's earnings potential, helping investors assess its value relative to its share price and making informed investment decisions. So, potential investors, those that are outside, look at the company on the earnings per share calculation for previous accounting periods, help them make decisions whether to invest in the company, determine its profitability, and make informed decisions in this regard. Okay, so a more broader formula looks at the net income, which is the bottom line, profit after tax, deduct the preference dividend are deducted from this net income and divided by the number of ordinary shares to arrive at the earnings per share in units of naira or kobo, depending on how much profit after tax is generated in that accounting period. So the net income is the profit after taxes and other expenses, internal and external. Preference dividend are dividend paid to preferred shareholders, subtracted to reflect the income available to ordinary or common stock shareholders. Number of ordinary shares account for any changes in the number of shares during the reporting period. So the unit price of the share or the nominal value, either 1 naira, 50 kobo, or 25 kobo, determines the accounts of changes in the actual share capital of the owners of the business. Okay, so let's look at a graphical example in the same company, Shadow to Nigeria PLC, to buttress how to calculate this ratio very graphically. Okay, so from the income statement, we're able to get our profit after tax, and that will be at the end of the financial year. So we're doing for 31st December 2020 only. And let's pick the profit after tax, which is 70 million naira for the period. So if you have your calculator, like we always use, let's follow me with your calculator. I'll use Excel to make the computations. Okay, so we have our profit after tax as 70 million for 31st December 2020. So 70 million is our profit after tax from the income statement. Let's go get our preference dividend. So most of the time it comes in additional information, but when you look at it as a current liability, it means it has been recognized, but it has not been paid. So we have preference dividend in our current liability here as 45 million now. So pick that and we go to deduct it from our profit after tax. So preference dividend is a fixed dividend that accrues to these special providers of capital called preference shareholders. So it's a restrictive covenant and it's a fixed dividend or fixed interest bearing element that must be deducted before distribution of the balance to ordinary shareholders. Okay, so we have it as 45 million naira, and let's have this as our net profit by tax. Okay, so let's deduct 45 million from 70 million, and we have 25 million as our net profit after tax for distribution. So now we'll get our ordinary shares. Let's get that from the SCI, the income statement. So our income statement, we have not from the income statement, now the balance sheet, I beg your pardon. We have the share capital at the end of 34th December 2020 as 200 million naira. So take note, and from a caveat here and this SCI, you can see number 4 states in the income statement, ordinary share capital was valued at 1 naira each nominal value. So take note of that so that you multiply the amount by the nominal value of the shares. At times it may be provided as 50 kobo, 25 kobo as the case may be. Take note to ensure the actual amount or the nominal value is multiplied by the share capital amount in the SFP. Okay, so let's go take the number of ordinary share, which includes 200 million naira. To 1 naira each is 200 million naira. So now let's have or calculate our earnings per share, which is the total net profit after tax divided by our number of ordinary shares. We have it as 12.5. So approximately we have it as 13 kobo. So our earnings per share for 31st December 2020 is 13 kobo provided to every shareholder that has shares in Shareholders Nigeria PLC. It's low, but it's still positive. It's a return that came, and it's commendable. So let's see what this means. Earnings per share represent the amount of profit attributable to each share of common stockholders, reflecting the company's profitability on a per share basis. So it means that 200,000 naira nominal share value was owned by shareholders of the company. And in that particular year, we just saw the calculation, 13 kobo was gotten for each unit of share owned per share basis to the shareholders of the company. It is a crucial measure for evaluating the company's financial health and performance over a specific period of a financial year, which is a 12-month period. The implication is that a higher earnings per share indicates greater profitability, which can attract investors, potential investors that look at the financials of the company. And this can lead to a higher stock price. While conversely, a declining earnings per share may raise concerns about the company's financial stability and would negatively impact the stock price. This is very critical. Earnings per share is often used in conjunction with other metrics such as price to earnings ratio, which is generally called PE ratio. We also look at that in subsequent videos or a subsequent video to assess the relative valuation of the company's stock or ordinary shares. So what are the causes and effects of a high earnings per share? Increased revenue, cost management, cost in terms of organic and inorganic, internal and external expenses, improved operational efficiency, or reduction in preference dividends. So where you have the bottom line as very high, then profitability or dividend to ordinary shareholders will also be high. And the effect is clear: enhance investor confidence, potentially increase in share price, and attraction of new investors. These are the effects of a high earnings per share. While a low or declining earnings per share is caused by declining sales, high or rising expenses, increased market competition, new entrants, a lot of competitors in that industry or market, and also adverse market or economic conditions. High cost of declining earnings per share. And the effect is bad. It decreases investor confidence, potential decline in share price, and difficulties in raising capital, internal or external. So in conclusion, earnings per share is a fundamental measure of a company's profitability and is critical for evaluating its financial performance. By analyzing earnings per share, investors can assess a company's ability to generate profit relative to its share base, and this is very important. Investors are interested in creation of value and growing their wealth in the short and the long run. So the earnings per share helps these investors, analysts, potential investors to make informed decisions based on this fantastic and important metric. Monitoring earnings per share trends is essential for understanding a company's growth trajectory and overall financial health. So, as chartered accountants in training, finance professionals in the office, EPS is important to monitor the growth strategy, ensuring that investments are ensured in each accounting period for investors and the owners of the business. This culminates in overall financial health of the company. This is very, very important. All right, and there you have it. A solid understanding of earnings per share and its critical role in evaluating financial health and performance. As you move forward in your professional journey, whether in the exam room or in the boardroom, mastering earnings per share will empower you to analyze a company's true earning potential. All right, don't forget to like, share, and subscribe for more insights. Drop your thoughts or questions, comments, observations in the comment section below. I'll attend to them. Keep refining your skills for a successful career in accounting and finance. Until next time, keep learning and growing. See you in the next video. And until then, bye for now.